whether next year we'll still be able to see some upside in the China A market, I say yes. First of all is for the China A market, we are still expecting a high single-digit corporate earnings growth. And especially in some of the niche industry or niche market segments that are riding on or benefiting from the structural transformation of the Chinese economy. Sectors like consumer, healthcare, industrials, or even basic materials that are supplying to the electric vehicle supply chain. So these are areas that we continue to see high growth. And on the other hand, we are seeing structural inflows into the China A market, especially after the launch of the Stock Connect arrangement and also the MSCI index inclusion. So even after a couple of years, foreigners still account for less than 5% of the daily turnover in the A-share market. And with the gradual increase of index weighting, I expect further money to flow into the onshore market. And even after the strong rally this year, China A, if you look at the MSCI China A onshore index, the forward PE is still at 12 times only. So it's still below the 10-year historical average. So going forward, if China is progressing well in terms of its reform or structural transformation so that the risk premium in the A market comes down, then that should drive the further re-rating of the China A market. So longer term, I'm bullish. I believe it's a structural story. But short-term performance is hard to say. I will still rely on our stock picking capability to generate alpha. If you want to allocate to China A, all you need to do is you need to have confidence in the structural transformation of the Chinese economy. So you know that China is heading towards a right direction, becoming a more domestic-driven economy, focusing more on domestic consumption and innovation, and the overall risk of the Chinese economy and the Chinese market is going to come down, then that's enough. You should make an allocation to the China A market because eventually that would be a good market to invest in. And then the investment vehicle should be an active strategy rather than going into the passive funds because you can avoid a lot of the poor quality or ex-growth industry and only invest in those sectors that are benefiting from the transformation or reform of the economy. What we try to do is we are trying to be very selective and careful when we invest in the China A market. We don't have to invest in the large cap or we don't have to invest in the benchmark names. We can find market leader in a niche market segment that continue to deliver growth at a reasonable valuation. So basically, we adopt a GAP approach, growth at reasonable price, and the three stock selection criteria that we use are growth, quality, and valuation. We focus on growth. When we talk about growth, we focus on earnings growth. So generally, we invest in company delivering earnings growth much faster than the overall economy. And we also prefer to invest in names that our earnings forecast is much higher than the street consensus. So later, there will be earnings upgrade. And on quality, the bottom line is very simple. We would rather miss an investment opportunity than exposing ourselves to unnecessary risk. So basically, if we are not comfortable with the quality, transparency, or corporate governance, we won't touch a stock. Just like an example is we also invest in state-owned enterprise, but we prefer to invest in SOE that have already launched or are going to launch SOE reform in the format of employee share ownership scheme or mixed ownership reform. So the management team interest is in line with minority shareholders. And on valuation, of course, we try to be more rational and disciplined. We only invest in names with a PEG ratio, in general, PEG ratio, PEG below 1 time. So we are not just riding on the EPS growth, but also positioning ourselves to benefit from the future re-rating or PE multiple expansion of the name that we invest in. And one key thing that I would like to highlight is we need to talk to the management. We need to understand the people running the business and be sure that their interests are in line with us. What are their incentives or motivation? environmental and corporate governance are already quite, or at least relatively better developed in the China A-share market. The social part is lagging behind, I would say. And when we invest in China A market, all along actually ESG are embedded in our investment process. So we assess the environmental impact and also the corporate governance, because these are two implicit factors that are affecting or impacting the share price performance of many companies. If you're not adhering to the environmental regulation, then your business may not be sustainable. And if you have a poor corporate governance, then investor will know about that, and that would also penalize your share price performance. But social impact or social responsibility is a relatively newer concept to many China A-share management. And this is especially an area that we would like to focus more on. And starting from this year, actually, we have a dedicated ESG analyst coordinating all of our ESG effort in the region. And what we are doing is we are not just assigning the ESG rating to the names that we own, but also actively engaging with those companies by arranging meetings or conference call purely for the purpose of ESG assessment. So we share with them our concern and raise some question and try to gather feedback from or action plans from the management team. And in such a cooperative relationship, we try to help them to improve on the ESG front.
Allianz Global Investors.